We are out of everything. That's according to a Goldman Sachs commodities guru, and he said he has never seen conditions so bullish for commodities in his entire career. And he attributes that to something called backwardation in the commodities futures markets, which I will explain. And we are going to look at this to see if does this condition indicate a very bullish future for commodities, or does it indicate a bearish future for commodities? Ready? Let's dive in. There are more commodities that are currently trading in backwardation since 1997. In total, that is 19 out of 28 raw materials trading in backwardation here. Backwardation is an uncommon scenario. Typically, commodities will trade in contango, and I'm going to explain exactly what those two mean. Futures contracts are the oldest financial instruments on Earth. We have records of futures contracts dating back literally thousands of years before any other financial contracts. And it's really very simple. Let's say I need some wheat because I'm a baker and I want to go make some bread. If I need the wheat, then I can go to you right now, you're a farmer, and I can buy a bunch of wheat from you. But the problem is, I don't just need wheat today. I need wheat next month. I need wheat in a couple of months. I need wheat next year. And so there's a chance that if I just buy the wheat that I need today, then in a month, there's a chance the prices might be higher then. There's a chance that in a couple of months, we might see some bad weather. The harvest might not come through as much as you were hoping it to, and there might not be as much wheat as we have right now. There might be a shortage. Costs might go through the roof. So me, wanting to protect myself from that, I might just buy up the whole year's supply. I might buy from you today everything that I need today and through the rest of the year. Now, that seems fine and dandy, except I need somewhere to store this wheat. And I'm just a baker. I don't have the means to store this wheat. And quite honestly, you might not have enough to sell me that much right now. This is where futures come in. I can lock up that contract today to buy wheat from you in a month, in 3 months, in a year. And the delivery date would be on those dates. Now, obviously, in a normal environment, I'm going to probably pay a little bit of a premium for that, right? Because if I'm going to lock in my prices and protect myself from prices surging later on, that would be good for you if prices surge, but not if we've already locked in a price. So you might demand a little bit of a premium because you might also have to store it for me until that delivery date. So there's costs associated with you locking up that future contract for me to come get wheat from you. So you're not going to just charge the same you would today. You're normally going to charge a little bit more than that. And I'm okay with that because I don't want to store it and I want to hedge the risk of those costs skyrocketing for me. So I'm going to go ahead and pay a little bit more to get it from you in a year versus getting it all from you today. That market condition is called contango. And that's the normal condition where the current price is lower than the future price. And that's just not some hypothetical future price. That's the amount I'm willing to pay today to guarantee that I can get that thing from you in the future. Now, I mentioned a few times that is the normal way that a market will trade. Now, when it's abnormal, it's doing something called backwardation. That means that if I'm looking at the prices, I'm looking at the prices today for that commodity, let's say wheat, and if I look out a year from now to lock up the future contract to get wheat from you in a year, that would actually be cheaper than buying it from you today. Now, you might think that's not that weird, and maybe that should happen quite frequently because that's just normal market conditions. The prices of things go up and down. But here's the problem. That introduces an arbitrage opportunity for anybody with the capital to take advantage of it, because I can sell something today at the current price and then buy it in the future at a lower price. Then I lock in the difference between the two prices. I can take advantage of both buying and selling that good, take advantage of those prices, and all of the opportunity to do that, all that profit opportunity will pull capital in. All that selling pressure on the current prices and the buying pressure on the future prices will bring those prices back to equilibrium. So it's not a condition that should be able to support itself or continue for a sustained period of time. But you might have noticed something there. You have to have the thing to be able to sell today in order to be able to take advantage of that. And this is where backwardation usually enters markets. It's when there is a shortage or that commodity is in a very tight supply. So certainly if you have a ton of wheat and the wheat prices today are much higher than they are in a year, you're going to sell as much of that wheat today as you can. And you're going to buy it from other producers with the futures contracts in a year from now, and you're going to take advantage of that. But when commodities become short in supply and there's not a lot of it, that price starts to skyrocket and nobody can arbitrage that profit opportunity away. Nobody can take advantage of that because nobody has the physical supply right now to sell, to take advantage of it. Now, obviously, this indicates that the current market conditions are setting the expectations that the future will be different from the present, that short supply, that tight supply will not persist, and that will result in prices being lower in the future than they are now. So we covered the first part of it, which indicates a bullish expectation on the prices because there's a tight supply, right? That's when things enter into backwardation because there's such a short supply that the price starts to skyrocket and people are needing to pay whatever they can, and there's not enough supply to push those back down and take advantage of that arbitrage opportunity. There's not enough supply, and so that indicates that prices could persist moving higher for at least some time. But we also took a look at the other side of the argument that says, but yeah, those futures prices, they're still lower. And so that indicates that the expectation in the market is still that this will resolve itself at least somewhat and that prices will come back down in the future. Otherwise, again, there's an arbitrage opportunity there to take advantage of buying it in the future. And then if they expect the prices to go up, then again, you can buy low and sell high. And so the equilibrium there, the market is pricing in the fact that it expects the prices to fall in the future. And this is where the third argument comes in that, in my opinion, tips it a little bit more over to the side of the bullish case for the price of commodities when things enter into backwardation, especially with commodities that are used up. When you start to see backwardation, that is an indication that there's desperation, that companies and people who are buying the commodity, they need it now regardless of the price. And so you're not seeing that same price action moving out into the future with those futures contracts because the desperation, the need is right now. It's not for getting it in 6 months. It's not for getting it in a year. It's for getting it right now. But you let me know whether this current situation where more commodities are in backwardation since 1997, whether that looks like a condition that is more bearish, that prices have peaked, whether that's more bullish, these supply shortages would continue, or whether maybe it's a combination of both and you expect the near-term prices to go up, long-term prices to go back down. Finally, I'll be speaking at an event in Dallas on March 5th. I would love to see you there. If you'd like to sign up, I've got the link in the description below. As always, I really appreciate you guys. Thanks so much for watching. Have a great day.